We start today's show with a number, 92%. That's the percentage of Nigeria's revenue that the International Monetary Fund says the country will spend to service its debts this year. This once again shines the spotlight on Nigeria's debt service to revenue ratio and renews the pressure on government to find more sources of income. The IMF has said Nigeria's debt sustainability is at risk and is cause for a great deal of concern and unease in the long term, reiterating the need for Nigeria to implement timely fiscal reforms. While launching the 2022 Article 5 consultation documents, the IMF's Mission Chief for Nigeria, Jasmine Rahman, noted that the increase in public debt in the past 10 years has been rapid. She said that the Nigerian government is approaching a time when it would spend all its income on servicing debts. As of the end of September of 2021, debt servicing to revenue ratio stood at 76%, implying that 76 kobo out of every 1 naira earned by the government was spent on payment of interest on debts. The IMF's latest statement estimates the debt servicing to consolidated revenue, that is, total revenues of the government and its agencies, for 2021 and 2022 to be 29 and 32.8% respectively. According to the IMF, the country's outlook faces balanced risk. On the downside, low vaccination rates also continue to expose Nigeria to future pandemic waves and new variants, while higher debt service to government revenues, though higher with U.S. interest rates and increased borrowing, pose risk for fiscal sustainability. But there are a few upsides that could be of benefit to the continent's largest economy. Today, we're looking at the IMF's assessment of Nigeria's economic viability. This is Business Edge. I'm Tolulope. Adeleru Balogun. Joining me today is Dr. Andrew Nevin. He's partner and chief economist for PwC Nigeria. Andrew, welcome back to Business Edge. Thank you so much for joining me.
Thank you, Tolo. It's wonderful to be here.
So let's start with a bit of background. So the International Monetary Fund recently concluded its 2022 Article 4 consultation with Nigeria, where it made an assessment of the country's economic viability. So first, let's do some kudos before the knocks. Nigeria's headline inflation dropped to 15.6% in December of 2021 from 18.2% in March. For the real economy, how significant has this been?
Well, I think that when we're having inflation near 20%, it's a dangerous territory. So we need inflation to be coming down. What we've said before is the primary driver of inflation is it's still difficult to do business. If we have a better infrastructure, better power situation, ease of doing business, then we'll just see prices moderate. If you look at a comparable country like India, they have quite efficient supply chains, quite efficient infrastructure, and you don't see high prices and high inflation. But it's good news it's coming down, and I think everyone understands that's really critical. The other issue driving inflation, though, quite frankly, is security and its impact on agriculture. Most 50% of Nigerians, I believe, over 50% spend over 50% of their income on food. So it's inflation in agriculture that's particularly difficult for the country. And because of the security situation, there's been less planting than there should be. So really, if we focus on the security situation, we find food inflation would come down.
So now let's get to that big number. The IMF is estimating 92% of Nigeria's revenue for this year will be tied up in servicing its debt. Is this really a realistic projection?
Well, I'm sure it's a realistic projection and sounds like really, really frightening, but I think people should keep a few things in mind. To begin with, the federal government budget is really small. It's 14 trillion naira of spending, and then collecting about half of that, and then we're saying about 90% of that goes for debt interest, so roughly 6 trillion naira, if I remember correctly. But the entire economy, the official size of the economy is 200 trillion naira. And the unofficial, I think when we do the rebasing, we're going to find it's actually much bigger than that, 250 trillion, perhaps as much as that. So, it's a big economy. These numbers reflect the fact that the federal government is actually very, very small. It collects a very small amount of revenue and it spends a relatively small amount. We really have the smallest federal government sector of any country that I'm familiar with on that. So it sounds like a scary number, but to be honest, we have said consistently over a number of years, we're not concerned about the debt situation in Nigeria. It's still a very small debt to GDP. We're not concerned that much about the revenue situation. The government understands, the federal government, the Minister of Finance, Budget and National Planning understands very well the need for revenue mobilization. The problem Nigeria faces is a growth issue. If we grow 6 or 8% or 10% a year, we will not have a debt problem. If we don't grow, we may have a debt problem.
And I remember that from one of our conversations last year, Andrew, when we looked at Nigeria's population growth rates, which was literally at the same point or just slightly outpacing the country's actual GDP growth rates. And that was a point you really hammered on in terms of how Nigeria is failing to grow its economy, the way the country's population is growing. So that seems to come back. It seems to be a reoccurring theme, even when we're having this debt conversation. So when you look at that, are the moves being made when we take COVID aside, because of course COVID hits anybody's plans truly, are sufficient moves and sustainable moves being made to work to grow Nigeria's economy in the numbers that we should be expecting? That time last year you were talking about in the double digits, but you said you might take something around that 6 to 7%.
Well, I'm very optimistic. I'm more optimistic than any time in the last 13 years since I've arrived here, more than 13 years ago now. Because I see on the ground lots of very positive things. I mean, I see every state I'm familiar with, you have now governors that are focused on unlocking dead assets, which is an issue that we raised. You have governors that are focused on, and MidCom, of course, who focus on the value of the diaspora. We have Nigerians inserting themselves in value chains. I feel like we're very close to liftoff. As I said before, the security situation is really creating problems getting that liftoff. The other thing is we still, even though I think most actors, public sector officials that I deal with are trying to do the right thing, there's still some resistance in some quarters, and we're not quite getting the ease of doing business, and we're not quite getting some of the blockages removed. But overall, I see tremendous amount of progress. And the other thing I need to add is, I'm very concerned, increasingly concerned, that the statistics we put out are actually not accurate. And this Nigerian Bureau of Statistics, of course, under Dr. Kali, as Statistician General, and now under Mr. Harry, I think they do a fantastic job, but they have very limited resources. And there's much more economic activity in this country that is being captured in a sector like real estate, for example, which you would think would all be captured in the formal numbers. So I think that the economy is bigger than we say. We're not quite able to bring enough of it into the formal system to be able to raise taxes, which is an issue for the policymakers. And there's just some issues we need to push through in terms of the PEBIC type of ease of doing business. Things just make it simpler, less taxes. I mean, one of the things we've advocated as PwC is, since I think 98% of the revenue from the federal government is collected from 6 or 7 taxes, all of those other charges should simply be eliminated. They create complexity and room for diversion, for example. So I feel very positive. We're close to liftoff. There's just a few things kind of holding us back. And once we get liftoff past 5%, no one is going to discuss the debt in this country or the interest rate burden, the interest, the coverage burden, the revenue, because it's not very large.
Okay, so while you say it's not very large, and while you say the problem more for Nigeria is a growth and revenue problem rather than a debt problem, there's still a lot of conversation. So as of June 30th, 2021, Nigeria's public debt stood at 35.465 trillion. The federal government owes about 29 or just around 30 trillion of that, and the states owe 6. Nigeria owes the World Bank, the Africa Development Bank, China, France, Japan, and many others. The IMF Nigeria mission chief said that the country's debt appetite has risen significantly in the past 10 years, and we've seen that trajectory as it's grown. So when you look at the debts, when you look at what it's being taken for, particularly on the federal government level, would you say it's been worth it for Nigeria to go into what, as you might think, an insignificant amount of debts, but when people hear that number compared to how much revenue Nigeria is bringing in, there are concerns. So do you think the debt has been worth it for the country?
Well, I mean, again, just to repeat it, the economy is 200 trillion. So when you have a debt number of about 40 trillion, if I remember right, at the federal government level, at 20% of GDP, it's very small compared to every other comparable around the country. I mean, you look at the UK after COVID, and I think it's approaching, certainly over 200%, if I remember correctly, perhaps more on that. So we still have a very small debt. It's just that we also have a very small federal government. Now, is it worth it? I mean, we like many others have said, for example, the foil subsidy. I mean, the number coming out, I've seen in the headlines now, is 3 trillion naira spent in the foil subsidy. We've now come into election year. I mean, yes, that 3 trillion naira would be better spent on Nigerian young people, on education, on healthcare, investing in Nigerians on that. And we've been clear about that. Of course, it's difficult now in an election year to make a change to the foil subsidy regime. Similarly, in the electricity regime, we've all seen the difficulties there. So we've diverted resources to some things that are perhaps not the most useful. But again, I don't think it's irreversible. I mean, the fact that we've misallocated resources over the last 5 or 10 years is nothing we can do about it at this stage. We just need to, in the words of Bismarck, stop doing dumb things. So some of these subsidies are at the top of the list, but as I said, I'm not sure it's going to happen in the short term because of the election year coming up. But we're definitely heading in that direction. I mean, it's very clear now when the federal government, for example, we have the Nigerian Development Plan, which replaces the ERGP. Which if people read it, they understand that the thinking of the federal government is so much clearer than it was a decade ago in economic matters. We need private sector capital. We need markets where appropriate to work. So eventually foil subsidy is going to go. The electricity tariff will be market determined in due time with respect to taking account of our social conditions. And of course, the governor of the central bank came out the other day and said, look, we're heading to a regime where the central bank doesn't give FX to banks to distribute to people. Banks have to source their own FX, which is the way it works in successful economies on that. So the direction of travel is clear. As I said, the minute we grow at 5, 7, 8, 10% per year, this debt issue is just going to evaporate. And I think that's why we've consistently tried to keep the focus on the growth issue and not bring it back to just talking about the debt coverage ratio, because it really just repeating that 92% number. And of course, it's not that the IMF is saying it, it's a reality. So Bodie and Augusto, our firm here that deals in fixed income markets, they put out 90%. It's the same number. So we all understand that. But if you focus on that number, you're not really understanding the foundational issues that we face in the economy.
And I like that. So if you focus on that number, we sort of miss the bigger picture. So that's where we're going to go when we come back. You've mentioned the fuel subsidy and the issue, but now the question has to be, it's going to go eventually, whether it's, as we said, most likely not this government because it's an election year coming up, but someone somewhere, sometime down the line will have to kick it out. And then how do we bridge that gap of the very real consequences that will come? And then you also mentioned taxation. The IMF has a number of recommendations regarding that. And I'm very sure Nigerians are not going to be happy about what those recommendations are. So Andrew, we'll pick up the conversation from there after this break and continue. Well, you, of course, are watching Business Edge, and we're looking at the IMF's assessment of Nigeria's economic viability. There have been recommendations on the 3-letter word that most people around the world dread, taxes. And of course, the fuel subsidy conversation and controversy continues. President Buhari asked for more money yesterday for the supplementary budget to fuel the subsidy. The conversation after this. In assessing Nigeria's economic strength, the IMF has noted that the Nigerian economy is recovering from a historic downturn, benefiting from government policy supports, rising oil prices, and international financial assistance. But it was concerned that despite the recovery in oil prices, implicit fuel subsidies, and higher security spending, those things are actually dampening positive impact. And just yesterday, President Muhammadu Buhari sent a supplementary budget to the National Assembly asking for 2.557 trillion naira to provide for subsidy on petroleum products from June to December 2022. Removal of the fuel subsidy has been something that the IMF has been recommending to Nigeria for a while. So I'll bring my guest back in, Dr. Andrew Nevin, partner and chief economist of PwC Nigeria. So Andrew, we're here again with this fuel subsidy conversation. We touched on it in some of our conversations last year. But the question now is, how can it be done so that the very real life consequences that Nigerians will face will be as minimized as possible?
Well, I mean, it's become such large numbers, and it's amazing we're sitting here having a talk about a fiscal crisis when Brent oil hit $94 today. We would have, if we were an oil economy, when oil's at $94, we should actually be in a very strong fiscal position. But it's a combination of a couple of factors. One is this foil subsidy has just become larger and larger and larger. And if I have my numbers right, we're subsidizing the equivalent of 400,000 barrels a day. And our production has gone down. So it used to be a few years ago 1.9, even 2.0 sometimes. Now it's 1.6. So we're really actually not exporting that much oil to contribute to the economy. And of course, the $94 is quite recent. So hopefully some of that will flow through. But because the price is so high, the fuel subsidy, conversely, has become also very large. And it becomes very difficult in an election year. And there needs to be a way to channel resources to the bottom of the pyramid in a way that both works, is not diverted, but also satisfies, for example, the labor unions that we're actually doing it. Now, my personal view, I won't ascribe this to PwC, but I think the eNaira is a great tool to be able to transfer money to the bottom of the pyramid, but that hasn't quite been rolled out fully, but it's coming, and it's a great innovation in Nigeria. But I again, as a personal view, I don't expect the foil subsidy to be removed in this year, just because it's an election year. And I think that these kinds of difficult decisions need to be taken when you have a new administration with a mandate. But we've been very clear over the years that if we're going to take the foil subsidy out, we also do need to put in something that benefits the bottom of the pyramid. As I said, the eNaira is a great tool for being able to do that. I know the idea was floated during this round of discussing removing the foil subsidy of 5,000 Naira a month transfer to vulnerable Nigerians. I think the number was about 40 million people on that. I think it's going to have to be something like that. But I mean, this also has to be in discussion with the trade unions. I know they've been very insistent that one of their conditions for taking the foil subsidy out is to bring on the production of foil, of the refineries, the 3 NNPC refineries. Of course, that's another source of loss to the country. We have these 3 refineries that are not producing any refined products, so we then have to pay not only to keep the refineries going, producing nothing, but we're also paying out of our tax dollars, our tax Naira, we're paying for paying the extra freight and extra cost of having to import fuel. So all of these costs are really adding up. I think that they will get addressed over the next 2 or 3 years, but as we all understand, it's just difficult right now to address these issues. So not a big surprise that His Excellency the President has to go back and ask for another 2.5 trillion Naira.
As you said, it's not a surprise, but for many people, it might be something of a disappointment that we're still having this conversation in 2022. So let's look at something else that IMF...
So close, though. We felt, 2019, even 2018, they broached 2019.
Exactly.
We would deal with this issue, and we're sitting in 2022. But, in the long scheme of history, this is not a very long time, and I'm confident it'll get resolved in a way that really benefits Nigeria.
We hope so. All right. So the IMF also recommended that Nigeria raise its value-added tax. And taxation is a very touchy subject for many Nigerians. And we've seen some changes to that space in recent times with the Finance Act of 2020 and the yearly adjustments that have been coming on board. But the IMF also said Nigeria should consider significant domestic revenue mobilization, improving tax compliance, and rationalizing tax incentives. Given the actual economic strength of the majority of Nigerians, we spend more than half of our income on food. High inflation continues to be an issue. High food inflation continues to be an issue. And you have millions of Nigerians who are in poverty and even below extreme poverty, as we've been told. Is taxation at this point in time, in the country's economic timeline, a really viable answer for Nigeria's problems, particularly in raising VAT?
Well, I think, we have some issues with what the IMF is saying. I mean, they sound like a little bit simplistic recommendations. As you say, we have a population that's under severe financial pressure. We have PwC surveys low tax morale, which people feel like the resources that are used by the government are not spent in the right way. And so the social contract is not quite working. So to come when we have this low tax morale and people feel like they're not getting value for money, and then to ask for a higher value-added tax seems a bit counterproductive. I would think that the government needs to show more that it can use tax resources effectively, in effect fulfill its side of the social contract. And the other part of it, of course, is we have a very large informal economy, more than 50%. So the bigger the wedge you drive between the formal and the informal, the less likely the people in the informal economy will decide to join the formal economy. And one thing that the Minister of Finance has done very well, for example, is bring in some new regulations to help encourage people to join the formal economy. So, for example, a company with under 25 million Naira in turnover can register with the CAC, but they don't have to start paying tax until they become quite a bit bigger. And that's the sort of thing that we need to do. So I think just raising that again in this country is not going to be helpful in the short run. There has to be a kind of a more considered approach to the situation we're in with respect to the tax mobilization. As I said, if you want to grow the tax revenue, we need a bigger economy, bigger formal economy, which means we need more growth. So I think if we focus on the growth policies first, we find that the tax compliance, the tax morale, and the tax revenue will all come into focus of where they need to be. But focusing right now, just trying to take more out of a somewhat stagnant economy doesn't seem like the right solution.
So we'll end where you've wanted us to focus, and that is on growth. So recommendations have always been that Nigeria needs to take strong, bold reforms and make very serious fiscal, exchange rate, trade, and governance decisions in order to lift the country and also get long-term inclusive growth. This is 2022. Yes, we're heading into election year, but we still have economic activity that's going to happen this year. If there were 3 things you would recommend that the Nigerian government focus on this year, what would they be?
Well, I continue to think, PEBEC has done an amazing job. Dr. Jamoke, of course, His Excellency the Vice President and His Excellency the President have really been supportive of it. I was at the 5th anniversary celebration in December at Aso Rock. But I still think we still have some way to go in the ease of doing business. As I said, the number of taxes, for example, the number of overlapping agencies. The government has assented but not quite acted on the Orange Shade report to simplify the federal government MDA structure. So that's one area where there's been progress, but just need more progress on that. The FX situation has been very difficult. Again, a difficult regime to change. But as I said, the central bank governors come out and made it very clear. We're moving to a situation where banks have to source their own Forex, which also means Nigerian companies encouraged to export more. I think that's largely going to be in services, and it's going to be in the big 5 agricultural commodities. And that will really allow us to eventually move, eventually being, I hope, in the next 1 or 2 years, to an FX regime that is really supportive to business. So I think that, and of course, then the FOIL subsidy is the third thing. And of course, we're seeing so much activity at state levels. I can't stress enough that the difference in the 13 years I've been here, really encouraging the last 2 or 3 years, when I look around at individual states and the things they're doing in education and health, in infrastructure, and also being able to attract investment into their own state. So that needs to continue growing. And maybe the final thing that we've talked a lot about is the real estate sector has to work. There's such a pent-up demand for housing, even when COE is not quite perfect. People are still building houses, and so even it shows you that if we could get the procedures around certificate of occupancies, get the procedures around the Land Use Act, the mortgages working, that would explode. So as I said, I'm more optimistic. I understand all of us understand the challenges this country faces, but every day I see the progress that's being made, and I think that a official growth rate of 6, 8, 10% is obtainable in the next few years.
All right, Dr. Andrew Nevin, thank you so much for joining me. We look forward to having you once again.
Thank you so much, Tola. It's just great to be here.
All right. And ending the conversation on a note of optimism that the largest economy on the continent can get things right. And one way Nigeria could do that is to possibly take advantage of these historically high oil prices. And that's where NC4 to Watch is going to kick off. We have the latest on oil prices. Stick around. And while we haven't seen prices this high in about 7 years, they've come down just a bit. The oil price has fallen after Russia said some troops are starting to return to their permanent bases, easing geopolitical tensions that have rallied prices. WTI for March delivery fell by more than $3 to settle at $92.07 a barrel, while Brent crude for April dropped to dropped by $3.20 to $93.28 a barrel. The Central Bank of Kenya says the country can make significant savings in the cost of printing currency with the adoption of a virtual shilling. This comes ahead of a public debate over the proposed rollout of its digital currency. The CBK's most recent currency printing contract, awarded to British security printer Adeleru in 2018 for the new generation banknote, was worth about £85 million, about 13.08 billion Kenyan shillings over 3 years. Zimbabwe's information minister has said that all land borders will be reopened for entry with immediate effect as corona cases in the country continue to decline. Travelers will be required to present a valid negative coronavirus test that is not more than 48 hours old to enter the country. And finally, Mozambique's Grindrod Limited, which is also listed on the Johannesburg Stock Exchange as a logistics operator, plans to triple capacity at its dry bulk port terminals in the country to cater for growing demand for coal exports from neighboring South Africa. Capacity at the 65% held Matola coal terminal will increase to 12 million tons yearly from the current 7.3 million tons in the short to medium term. And that's the conversation for today. Follow us on social media, subscribe to our YouTube channel, and of course, download our mobile app and take News Central with you wherever you go. Don't forget, we are here 11 a.m. Monday through Friday, West African time, where we put business, the economy, and finances right here on the African continent, front and center. I'm Tolulope, Adeleru Balogun. Have a fantastic day.